All right, good morning. We'll let the others trickle in as they can. So thank you all for attending today. Those of you who are here either really want to be here or you're here to make me feel good, right? So, we're here to talk about tax planning for land exchanges. My name is Dave Brown. I'm the owner of IPE 1031. We are a qualified intermediary company located in Des Moines. There's some information at the end of the rows. If you weren't able to grab some, maybe if you can reach down and pass it down to others. But there's a pamphlet here that talks about our company and who we are. There's some information if you want to reach out to us, gives the bio and background. I'm sure there are some attorneys in the room, and I apologize for the poor joke, but I'm a recovering attorney. I used to practice and actually started our company in 2003. So we have been in business for nearly 20 years, and over the past 20 years, we've grown into one of the largest 1031 exchange qualified intermediaries in the country. There's some really big fish out there, but in terms of the independent qualified intermediaries, we've really established an incredible presence, certainly locally, but also nationally in terms of ag land transactions and the volume that we see. So if any of you have questions, you're more than welcome to stop me to the extent that we can make this beneficial for you versus me just talking. It engages the group, and also afterward, of course, you're welcome to reach out if you have questions about exchanges generally. Our contact information is on the back of this. So, we'll talk certainly about 1031 exchanges, but also some general tax planning with land sales, given where we are in the market today. And just to give you some idea of scope and perspective, I think you all, you're here, you understand, land exchange or land sales and volume, but it's been incredible in terms of the volume that we saw in 2021. I was looking at some of the People's Company statistics, and in terms of the number of transactions that they handled, it's been some of you can speak maybe closer to this, but I think maybe 4 times what you would ordinarily see in a normal year. That is translated almost to where we're at with our exchange transactions. So in 2020, we handled 520 exchanges. This last year we handled 870, culminating with over 100 deals per month through the last part of the year. So we're really busy, and it's been a really robust time for farm sales and transactions. Generally speaking, I'm hearing that that's likely going to slow down in 2022. I think there was a lot of selling due to potential tax ramifications or the proposals through coming out of Washington, D.C., which I'll talk a little bit about. But just to give you an idea of where we stand currently, up here is a slide of what we're looking at for capital gains tax rates. So really we're right where we have been since the Tax Cuts and Jobs Act was enacted in 2017. 15% federal for up to $200,000 for a single person, $250,000 married. There's a 3.8 net investment income tax for earners over 200 and 250 if they're married. And then there's a 20% for those who earn $400,000 as individuals and $450,000 if they're married. There's gain due to depreciation is taxed at a higher rate. So if you've taken depreciation on your assets, it can be taxed higher. In other types of depreciation, it can be taxed at ordinary income tax rates depending on how you've taken depreciation in the past. And beyond the federal capital gains tax, you also have state capital gains tax to consider. In Iowa, that's 8.5%. In California, it can be up to 13.3%. And of course, there are some states that don't have capital gains taxes since, based upon their tax regime. But, when you're looking at a land sale transaction, we're looking at the federal plus the state. And when I'm talking generically about a sale transaction, when somebody gives us a call, depending on the income, it can be anywhere from a combined general tax rate of 15% all the way up to a third. And in some cases, when you have significant depreciation recapture, it can be much higher. So that's our baseline that we're talking about when you have a land sale or any type of a sale of real estate. And let me go back here. What's changing? What's potentially happening in 2022? I am on the Government Affairs Committee. I'm co-chair of our National Government Affairs Committee for the Federation of Exchange Accommodators. 1031 is obviously statutorily driven. It's a critical tool for landowners, and obviously it's our business too. So I've been extremely active over the last 5 years in terms of educating members of Congress about the importance of 1031 and also having a pulse on what's going on in DC. Back in 2017, when the Republicans were in control and the Tax Cuts and Jobs Act came out, there were proposals to adjust depreciation and expensing that would have impacted exchanges. But generally, on the Republican side of the aisle, we have always been in really solid footing relative to retention of Section 1031. So as the Tax Cuts and Jobs Act came out, we educated Republican members of Congress, and we've continued to do that over the years. And we're successful in our efforts during that period of time with preserving the tax provision. So fast forward to when the Democrats took control of Congress recently, we shifted direction and educated Democratic members of House Ways and Means and Senate Finance. And over the past year, we've had 50 different fundraisers with Democratic members of both the tax writing committees. And what has come out of those discussions is that when members on both sides of the aisle are educated about Section 1031, they understand the critical importance of the tool. And the point being that if folks were faced with the decision of selling an asset and paying the tax versus selling and being able to defer the gain into the next into another asset, there's a broad understanding, bipartisan understanding that would cause transactions to come to a screeching halt in many ways. So with the proposed tax changes that were in the Biden budget, as well as some of the earlier Build Back Better proposals, we have successfully advocated in favor of retention of 1031. If there was ever a period of clear sailing ahead for like-kind exchanges, we're in that period going forward. So it's been a lot of years of hard work, and there has been questions about what happens to 1031 exchanges in the future, and I think that we're in a very good place. So dovetailing that to individual tax rates, capital gains tax rates, in spite of progressive proposals to increase capital gains tax rates to up to 28%, in spite of proposals to increase individual income tax rates to a high level, those have been met with significant resistance to moderate parts of the Democratic Party, to the point that any proposals to increase income and capital gains taxes through Democratic proposals have effectively been shut down, with some exceptions for high-income earners. So there's proposals for net income tax increases for earners over $5 million and $10 million in certain circumstances, and then there's also an application of the 3.8% net investment income tax to pass-through entities as well. But by and large, and those are out there, and even those proposals are at risk given where the Build Back Better proposal currently stands. And those are in that proposal, which for those of you who follow any of that, it's at a standstill due to some of the moderate resistance to some of the proposals included in there. So, there was huge transactional volume and incentive to drive sales and transactions in 2021. A lot of that was based upon the specter of higher capital gains tax rates in the future. Hopefully this doesn't, I don't jinx this, but I think that, I think it's a fair assumption that going forward, we're going to have general stability in capital gains tax rates. So when you're making decisions about Do I sell in this tax year? Do I sell in the next tax year? Do I accelerate my sale decisions? We're really, frankly, in a really good place. So a lot of that pressure has been removed based upon what we are hearing from the Democratic members of the tax rating committees. And we've had personal discussions. I mean, I can tell you just from these 50 different fundraisers, Zoom has really been quite an opportunity to connect with the members. And there's a really strong support for, in many cases on those tax writing committees for keeping investments flowing, keeping rates at reasonable rates. And frankly, there's a resistance to raising taxes because it would be politically difficult to do. So takeaway from here is that if you are considering a land sale in the future, for the foreseeable future, we're in a pretty good place as far as tax rate stability. So here's another slide of interest, and I'm going to talk just about exchanges. So when we're going through this lobbying exercise, we took our transactions for a 5-year period, $3 billion of properties exchanged. Of that, approximately 75% were farms, which is really remarkable. So when you think about the impact and the value of Section 1031 to the people in this room, this demonstrates that it's absolutely critical. And also, of the roughly 2,500 exchange transactions, the median value was $443,000. And what we determined is that based upon the size of land sales transactions, there was a proposal to cap 1031 at $500,000 of gain. That would effectively have repealed exchanges for both commercial and ag assets. And again, we're beyond that at this point, so that's a really big victory and success. So let's move on here. And I'll quit talking about the legislative stuff, other than I think it's important for you those of you who are making decisions. Section 1031 adds $55 billion of total value added over a 10-year period. And really, the other reason that 1031 has remained in place is because it's really a small cost. The cost over 10 years to the Treasury was $20 billion. It creates $55 billion of additional economic activity. And when you factor in the amount of dollars that they're looking to raise, and this is just using the Biden budget, it's a 0.008%. That's how much it moves the needle. So that's one of the other reasons that we were able to be successful. All right, so let's move on to the nuts and bolts. So you're looking to sell a farm asset. We have federal capital gains tax. If I tax that, this is $1 million gain, which is all day, every day in the farm world right now. At 20% for federal capital gains, we have $200,000. We have the net investment income tax of 3.8%, plus state capital gain tax, a tax in this example of 8.5% with the state of Iowa. If somebody were to cash out of this asset on $1 million gain, there would be $323,000 of tax, which would leave $677,000 left to reinvest into a new asset. So I suspect many of you, if you have $1 million gain, and this is the tax consequence, you would elect to not sell. And I think that is really what moved the needle here. And in fact, the Iowa Farm Realtors have estimated that if Section 1031 went away, anywhere from a third up to a third, in some cases they estimated that half of transactions would no longer exist. And there's been this knock on 1031 in the past that, hey, people are buying at auctions, they're driving up land values because they want to avoid the tax. And certainly there are instances, and there's some tax-driven motivations behind 1031 exchange buyers, but when you look at values over time, they parallel commodities, they parallel different factors that are influencing land prices, including inflation, hedging against dollar depreciation. It's the economic benefits that drive the values of sale transactions. And actually, another critically important issue here is 1031. There was a study out of Texas A&M when everybody was saying 1031 is driving land values up. this Texas economic study of A&M said that, hey, 1031 actually has the effect of increasing supply because there's more willing sellers. And because it increases supply, it actually has the impact of reducing values because it's a supply and demand factor. So if all factors being equal, 1031 exchanges have the impact of stabilizing land values versus increasing them. I bring that up every year because inevitably at some point it crops up that 1031 gets beat up because there's this misperception that people are purchasing to avoid taxes. And certainly that's a component, but there are other reasons for that. So, before we get into exchanges, we've got several options here. We can hold, we can cash out, we can do an installment sale, or we can do a 1031 exchange. And reasons to hold are it's a strong asset, there's strong cash flow. Sometimes folks just don't want to pay the tax. And also with estate planning, a reason to hold an asset is that currently, and again with the work that's been done with the members of Congress, if I own an asset that I acquired for $100,000 today, and I live another 50 years, and my kids inherit the property, and it's worth $1 million at that point in time. The basis is that's your tax cost, that's your original investment. You don't have to pay tax on your original tax cost. So if my kids inherited the property, their basis would be stepped up to $1 million. So if they sold that asset for $1 million after my death, they would not have to pay the capital gains tax. So whenever you have, if you're an advisor or you're a broker or you in your situation or you have parents or whomever, there's an incentive to hold an asset for an older asset owner because of that stepped up basis. So, it's in many cases not the right approach to selling cash out of an investment as the later stages, as the late stages of life come up. Really the other issue is, what are you going to buy now? You can sell high, but you're also going to buy high. So you got to make sure that that investment decision makes a lot of sense for you as far as what you're going to acquire. Reasons to cash out, debt reduction, relatively low capital gains tax rates. If you have some losses that could offset, the gain, that would be a reason to sell at maybe a lower marginal capital gains tax rate than what you would have in previous years or what you would project in the future. And then diversification. If you're going to do an exchange, it has to be real property for real property. You cannot exchange into stocks, bonds, notes, other non-real property assets. So the only way to diversify without into another type of asset is to cash out, pay the tax, and move on. And then there's a lot of folks that start 1031 exchanges and say, we've got, I'll talk a little bit about this, but there's 45 days from the date of the closing of the sale to identify new property. And oftentimes they'll start the exchange and say, gosh, I'll see what I can go out and find. And the worst case scenario is that on day 46, the exchange fails, the exchanger gets their money back, they pay the tax, and life goes on. So, there's oftentimes an incentive to begin a 1031 exchange transaction and not move forward with it because you can't find that right property. So, we've got holding, cashing out, installment sales. This is an installment sale is basically a sale of an asset that spans 2 or more years. One tool that we typically see at the end of the year for tax planning is if somebody were to sell an 80-acre farm for $400,000 and it was all gain, they could sell a half interest in 2021 and then sell a half interest in 2022, or they could take a down payment in 21 and take the next payment in 22. And by splitting up that sale in different tax years, they can lower their marginal capital gains tax rate. So that's the most common way that we see installment sales utilized in land sale transactions. In my prior case, this is a little different here, but we've got our sale price of $1 million, $200,000 basis is what they paid for it, and an $800,000 gain taxed at roughly a third. For a basic example, they'd be looking at $240,000 of tax. So in this instance, if you split up the payments over 5 different tax years, instead of paying the $240,000 because of the lower tax rate that they're able to achieve, they can pay less tax, $160,000 in this instance, and perhaps derive some investment, some interest income as a result. So, before we get into Section 1031 exchanges, these are all different tools that, you can think through before you make a sale to evaluate what's the best way to structure the transaction so I'm either minimizing or deferring tax. I'll stop talking for any questions or comments. I don't see any nodding off. That's good news. So, now, Section 1031 has been in the tax code for 100 years. The reason it's been in the tax code for 100 years is because Congress has recognized that if you are selling an asset and you're reinvesting those dollars into new assets, why would we make them pay the capital gains tax? Because that money stays in the economy. It helps drive GDP. It helps drive job growth. Every land transaction not only impacts the landowner, it impacts the real estate broker, the attorney, the mortgage lender, the abstractor, the whole flow, downstream flow of economic activity that is produced as a result of reinvestment. It just continues to stay in the economy. And that's why 1031 has really stood the test of time. Any property can qualify as long as it's considered real estate. Any real property for any real property. So if you have heard that if you sell a farm, you have to buy a farm only, that's not correct. You can go into any other real property asset. It can be office, retail, storage. It doesn't necessarily have to be income producing. It can be held for appreciation. So somebody could buy a timber asset or a recreational asset that may not have a lot of income, but it's held for appreciation. That definitely qualifies. Vacation homes in limited circumstances can qualify as a replacement property. So if we have a landowner or a farmer who owns 1,000 acres, they want to sell off 100 acres for $500,000 and go buy an Arizona condo, or they want to go buy something in Kansas City that's closer to the grandkids or whatever, as long as that asset is used for no more than 14 days personally per year, and it's rented for at least 14 days per year for 2 years after the exchange, that can be a qualifying asset or qualifying replacement property. And then after that 2-year period, they can convert it to a personal use as a personal residence or a pure vacation home. Really a remarkable planning tool for folks who are looking to diversify and do something different out of some type of business asset. So in 2017, you were able to exchange personal property assets for other personal property assets. You can no longer exchange personal property assets. Exchanges of personal property assets were replaced with immediate expensing. So if somebody sells a combine in 22 and they buy another combine in 22, they can write off that second combine, and that's going to eliminate that tax they would ordinarily pay through immediate expensing. And the reason I bring that up is that now we're just dealing with exchanges of real property only. So with the tax bill changes from 2017, so our examples here, we could trade 80 acres of bare ground for another 80 acres. We could go from 80 acres to an apartment building, to a retail center, to a vacation home, as I mentioned, or any other real property held for use in a trade or business. Or an office building could be exchanged for a farm. One of the more common trip-ups we see is if somebody has an improved asset, specifically single-purpose ag assets, hog buildings, grain bins, other livestock facilities. The way that those are taxed is oftentimes as 1245 property, and 1245 is an Internal Revenue Code section, which allows somebody to take single-purpose ag use assets and reclassify them as personal property. And whenever you do that, you get to take accelerated depreciation. You can write that off in year one. The problem with that scenario is we have a lot of folks who say, hey, I want to get out of this hog business. I'm ready to move on or do something different. You cannot go from highly depreciated single-purpose ag assets into farmland into further recapture, because it gets pretty technical, but the general rule is that 1245 recapture is going to be taxed first, and you have to pay that back before you consider the 1031 exchange component. So one of the bigger problems, issues we see when folks are looking to do exchanges, and this may fit some of you, is if you have improved ag assets on your property, there's some chance that even though it's real estate for real estate, you still might have to pay back that recapture. And 1245 recapture is taxed at ordinary income tax rates. So, that $750,000 hog building that you acquired and wrote off in year one feels really, really good on the tax return, but eventually you have to pay that tax back if you were able to cash out of it. So the only way to defer the tax on a single-purpose ag structure, again, grain bins, hog buildings, whatever, is if you go into some other asset that has as much or more 1245 property. In some cases, if it's a convenience store, car washes, some of those, more improved, specialized assets can work for a 1031 exchange in those circumstances, but that's a real, we see that a lot, and it trips a lot of folks up. Any questions? All right. Yes? Exchange with a boat? Yeah, you cannot do that. You cannot exchange a farm into a boat or an RV. It's a good thought, but that is not allowed.
So like in that office scenario, that office building is depreciated down, but on the farm there's not as many dollars worth of depreciable assets. I mean, you got some tile and maybe some fencing or fertilizer credit, but you can roll that whole thing in with in a 1031.
Okay, so the question is, you've got depreciable assets in an apartment building or an office or something like that. There, you can do a cost segregation study, and you can carve out portions of those facilities: the carpet, the lighting, the wiring, these panels. Those can all be cost segregated out so that you can write those down on an accelerated basis. Generally that's a small portion of those types of assets. So it's a lot easier to do an exchange out of an office building or an apartment complex into a farm as long as there hasn't been accelerated depreciation. Straight line depreciation, as long as that's been taken over 39 and a half years in most cases, you don't have a problem with recapture if you've taken straight line depreciation on an asset. It's only when we have accelerated depreciation that you run into those problems. So fence and tile, those can be reclassified as 1245 property, so that can help you offset some of that. But it's really the highly specific single-purpose ag assets that we run into problems, whereas other improved assets, as long as there's straight line depreciation, there's usually a way to work through that. And sometimes it's by saying, gosh, my allocation to the underlying real property and the land and the building is high, but my allocation to the depreciable assets is really low because they're not worth much anymore. So it depends how your tax preparer treats that as to whether or not there'll be a big hit. All right. So I mentioned that personal property exchanges were eliminated, but really the key part of this is that you can utilize personal property purchases to potentially offset any capital gain that you would have. So if somebody were to sell a farm, or they were to sell some investment property asset, if they went out and acquired a personal property purchase, in some cases that personal property acquisition through the immediate write-down can offset the capital gain that they otherwise would, or the gain that they otherwise would have had to pay. So instead of going from a real property asset to a real property asset in a 1031 exchange, if there's a need for some personal property asset, whether it's ag equipment or really anything, personal property acquisitions can be utilized to reduce your general tax burden when it comes to tax time, when you factor in your sales versus your expenses. So the takeaway here is that with some good planning, personal property purchases, business purchases, may be a solution or an alternative to a 1031 exchange. That goes away after this year, by the way. It starts to phase out. So you can write off 100% of a personal property purchase in 2022, and that phases down by 20% per year for the next 5 years. So immediate write-downs will be limited to 80% in 2023, 60% in 24, and so on. So if you're going to buy something or build something, in fact, you can build a machine shed that's a single-purpose ag use structure. And if you're an active farmer or this is in your business, you can write that facility off this year 100%. This is the last year you can write it off 100%. Next year it's 80%. Next year it's 60%. The balance can be depreciated over time, but that immediate incentive ends, 100% incentive ends this year, absent an extension in Congress, and I'm pretty sure that's not going to happen. I think that's a safe prediction. Yes? Good question. A machine shed with living quarters. Yes. So, personal property use doesn't work, but you could segregate, the values or carve out, some portion of that to make that potentially work. Yes, Justin.
Is that the same with the accelerated depreciation for convenience stores as well? I've heard that's starting to happen.
Yeah, so the question is accelerated depreciation for convenience stores, that all starts to, transition toward that reduced rate or ability to write it off. All right. So 1031 is not a tax avoidance tool, it's a tax deferral tool. If we sell for $1.5 million and our basis is $500,000, our basis carries over to the new property. All we're doing in a 1031 exchange is moving the tax to a different asset. If somebody eventually cashes out of the property, they're going to pay the tax. So if I sell for $1.5 million and I buy for $1.5 million, my basis and then that new property is going to be $500,000. The gain is deferred. It's not a tax avoidance tool. You can't avoid it, of course, unless you have that stepped up basis and it's passed on. Now, let's go back to my other example of if you sell that $500,000 farm and you go into the condo in Arizona, and after 2 years you move into it as your personal residence. As a personal residence, you can exclude up to $500,000 of gain for a married couple. There is an ability to, over time, eliminate the capital gains tax that's been deferred under that Section 121 personal residence gain exclusion. I don't have the formula exactly right, but as an example, if somebody converted it in year 2 and they lived in it for 2 years after that, they could exclude, a percentage of their of the time that they lived under Section 10 a percentage of that time they lived in the property. So 2 out of the last 5 years, an example. So they sold that in year 4, they could exclude 40% of that gain. And again, I'm probably messing up the formula, but the point is the more that you live in a replacement property over a period of time, the more that you can exclude that tax if somebody were to ever cash out of the personal residence. Another important, interesting topic here is 1031 is used as a time value tool. And there's been studies that have said that in 88% of investment sale transactions, at some point during the life of the investment, 88% of properties are cashed out of. So, people are using it to take, their equity, move it into the replacement property. They get to use those tax dollars to build their wealth, but at some point in the future, there's a cash out event that occurs. So really, that demonstrates the point that 1031 is used by investors and asset owners to defer the tax. In the thought that people defer, and then die, and there's no tax paid due to the stepped-up basis. That's a much smaller percentage of transactions than what people realize. And really, if you defer, here's the example, over a 30-year period, the time value of money, in this case, assuming, in the annual return of 10%, I know that's a big number, but I think, and the farm brokers can correct me if I'm wrong, but I think that the total return of farm ground, factoring in yield and appreciation, has exceeded 10% for really pretty uniformly. Over a 30-year period, the benefit of deferring the tax and keeping those dollars invested, in this case, is almost $500,000. So, it should be a tool if you're active in real estate transactions that you're, really dialing in. All right, so we're here today because if you want to do a 1031 exchange, you have to use a qualified intermediary. A qualified intermediary cannot be your attorney or accountant, your realtor, your financial advisor. It has to be a disinterested third party. This is all we do. We have a company that's specifically set up only to handle qualified intermediary transactions. We don't have a law firm, and because we don't serve as legal advisor to folks and we don't practice law, we are able to exchange and help anybody who's doing a 1031 exchange. But if you're looking to sell a property, do not close on the transaction until you've hired the qualified intermediary and 1031 exchange documents are in place. Our role is to, what we generally do is we'll get a call from somebody who says, hey, Dave, I'm looking at selling this property. I'm going to close on it March 1. What do I need to do? So, our process is we'll get some information about the land transaction. We'll talk about the facts behind it. There's a very common misconception that 1031 is form-driven and that it's just filling out the forms. That's not the case. I can't back this up, but I always say if I went to work as an IRS audit agent, I could disqualify 50% based upon, sort of the issues that come along in a 1031 exchange. And right now, the IRS is weak in terms of staffing and their ability to go through these, but the Build Back Better bill proposes $80 billion of funding for the IRS, which is to increase audit activity because one of the revenue raisers is, $500 million of, taxes that are not being paid because they're not being handled correctly. So, it's going to be really, really important going forward to make sure that, your taxes are being handled the right way, that your 1031 exchanges are being handled the right way, because I think that it's only a matter of time before audit enforcement increases substantially. Yes? Okay, the question is, do we replace the title company or work with them? So there are title companies that handle exchanges, but we are an independent qualified intermediary, so we specialize in just handling the 1031 exchange. So what we would do is we would work with the title company at the closing process to make sure that the account's been set up, documents are handled the right way. We just administer and specialize in handling the 1031 exchange process. All right, I'll wrap it up here and then we'll go to some questions. I think I have 10 minutes left roughly. So, I'm going to blast through this. Really what I would tell you all is that if you're considering a 1031 exchange, we're here to serve as your resource. Call us early in the process to plan for it, to make sure that you're setting it up the right way, to make sure that you're avoiding pitfalls. I'll tell you one quick hitter here. Related parties in a 1031 exchange, anytime you're buying from a related party, and we're seeing more and more and more of that with the generational transition of farmland assets. If you're buying from a related party, that's a prohibited transaction in a 1031 exchange. There's exceptions to that. There's ways to potentially work through some of those issues. But oftentimes we'll say, brother is selling 80 acres to the neighbor. Brother wants to buy from his siblings who received a stepped-up basis from the estate. That's a problem. So, there's a lot of little things like that if you engage us early in the process, we can help you keep you from making mistakes. You can learn more about us. Important things to think about when you're working with a qualified intermediary. Bond, E&O coverage. We have one of the highest errors and omissions insurance policies in the country for our company. We've handled billions and billions and billions of dollars of exchanges, so we can safeguard your funds, but as important is making sure that if there was some sort of an issue or concern with the way an exchange was set up, you want to make sure that E&O coverage is adequate and in place. All accounts are separate. You don't want pool accounts. When we work with folks, everybody has a separate, segregated account. They get statements from the bank. So it's just obviously important when you're working with a QI to make sure they're on the right track. I'm going to go through quick hitters on really the three most important rules. There's a reference guide that you should have. These are the basic rules that you can take with you. If you ever have questions about an exchange, they're all listed on there, including 1031 cooperation language, which is the bottom of page 2 of that handout that I gave to you that goes in the purchase agreements. But, really the basic rules are you have 45 days from the date of closing to identify new property. That's not the date that you enter into the purchase agreement. You could enter into a replacement property purchase agreement before your, sale property closes. That's fine. You just want to make sure the closing on the sale happens first. The closing on the purchase happens second. If you can't do that, that's fine. We do reverse exchanges where somebody has to acquire that replacement property first. We've done tons of these in the last several months because it's the seller's market. You go to an auction, closing is coming up on December 31. You have to close. You can't get your relinquished property marketed and property marketed and sold until after the first year with the closing set for March 1. There's a tool called a reverse exchange where you can buy the replacement property first and sell the other property second. It's expensive. It requires purchase, us basically taking title to that replacement property, but it's an incredibly powerful tool, and we actually have some exchangers that are choosing reverse exchanges because if you can buy the replacement property right, that's where the challenge is in this market. So they'll lock in their purchase of the replacement property, park it with us. They have 180 days from the date that it's parked with us to get their relinquished property sold, marketed, closed within that period. So the reverse exchange, depending on the scenario, can be a moneymaker. 180 days from the closing date to purchase the replacement property. And the other important part is you just cannot simply reinvest your gain. So we get calls fairly routinely where somebody says, I sold for $500,000. I've got a $300,000 basis and a $200,000 gain. They say, all I'm going to do is buy the $200,000, and they think that they can further tax by simply reinvesting the gain. That's not the case, okay? To defer all your tax, you have to buy as much or more than what you sell for. You have to reinvest all the equity, and then you have to, replace the debt or come up with new debt on the replacement side to make sure that you're covered. So that probably made 0 sense because I'm going way too fast here, but here's the example. If somebody sells for $1 million and they buy for $800,000, that's fine. but because they traded down by $200,000, they're going to pay tax on the $200,000. You can do a partially deferred exchange. That's not a problem. Okay, so let's in this case assume the basis was $500,000. If they bought for $800,000, they would defer tax on $300,000 of gain, the difference between their basis of $500,000 and the purchase price, but they would pay tax on $200,000, that being the trade down in value. So make sure that, you know, your target is whatever you purchase for, whatever you sell for is what you should purchase for. But again, you can do a partially deferred exchange. It's just something you want to talk through with your tax person. So yes.
What do they do if there's debt, like on an office building? You know, can they not pay down that loan? How does that work if there's still debt on the asset that's getting sold?
Okay, so the question is what happens when the sale of the relinquished property, in this case, an office building. So let's say, you know, $1 million office building sale, debt of $500,000. The IRS has a safe harbor that says, hey, banks, you got to get paid off. So we're going to let you pay off the debt on the relinquished side. And as long as you incur new debt on the replacement side, that's going to offset the debt relief that was given on that side. So there's, I mean, no bank would release a property if you couldn't get that debt paid down. So there's a mechanism for that. All right, I have left a little bit of time here for questions, and I appreciate your time and attention. But anything else, any other questions? Yes?
Are there provisions in the non-safe harbor for extended periods of time for replacements?
Are there provisions in the in the 1031 safe harbor for extensions of the deadlines? And the answer is generally no. There are presidentially declared disaster areas where sometimes people get into a derecho or whatever in several counties or placed into a presidentially declared disaster area. In those cases, the deadlines are extended. There was a COVID extension when all that went through. There are ways to save if somebody acquires a replacement property and they park it in a reverse exchange and they can't get their relinquished property sold within the 180-day time period, you could sell to a related party and defer the tax. I mean, in some cases, but rarely, it's possible to work with those time periods, but those deadlines are firm. If it comes on Christmas, that's when it's due. Yeah.
What are your thoughts on Delaware statutory trusts? How does it play into these kind of transactions?
Okay, so the question is there's Delaware statutory trusts, and basically what those are securitized replacement properties. So you'll have companies that will come in and acquire an Amazon distribution center or acquire a portfolio of Walgreens or some other, they'll package it up as replacement properties. Those are legitimate replacement properties. They've been blessed by the IRS in terms of the ability to exchange into those. It really comes down to the investment decision and working with a financial advisor to understand what the investment is, which is really beyond my area. Yes?
Is there any similar vehicle or mechanism for business equity capital gains?
Okay, the question is there a deferral tool for sale of businesses? And it used to be before the Tax Cuts and Jobs Act, there was some ability to, do some of that. But no, there is no corresponding provision for a sale. There's some exemptions for state capital gains taxes with active, use, but not a corresponding tool like that. I mean, and there's some mergers, things that again are sort of outside of my area. If there's an acquisition that can avoid some of that, but in terms of a sale for cash, I'm not aware of anything. And if somebody else knows different, tell me. Yes.
Just not really 1031 related, but what do you see tea leaves in the estate tax?
The question is, what do I see as far as tea leaves in the estate tax? I have no tea leaves to read. So, yeah. Go ahead.
When you exchange a new property, your basis you bring over, after that basis follows you to the new property, are you allowed to increase that by reinvesting money into that property, or is that basis
All right, yeah, so the question is, yes, how's the basis work? So if I have my $1 million asset with a $500,000 basis, my basis of 500 goes into my new replacement property asset of $1 million. If I put $200,000 of improvements, that's going to increase my basis to $700,000. And then depreciation is going to reduce your basis. So if you make those improvements, in some cases they can be tenant improvements or whatever, if you can write those down, that's going to drop your basis back down due to depreciation. So, you've got gain due to appreciation and gain due to depreciation, and those are the two calculations you have to work through. Yes?
So there's the $500,000 capital gains tax avoidance if you're married filing jointly, right?
There's a $500,000 exemption for sale of a personal residence for a married couple, right?
Okay, so just for personal residence.
Just for personal residences.
Vacant land is your only option, a 1031, if you were to sell that property and it's appreciated.
Right, so your question is if it's vacant land or some investment property is your only option, 1031, and the answer is yes.
So you have to take title the same, like from one to the other?
So another good question, somebody's somehow been involved or understands this. However, the relinquished property is owned is how it needs to be titled on the replacement side. So if husband and wife own on this side, or brother and sister, and they're looking to defer all the tax, they have to go together in the same way. At some future point, you can do some tax planning and put spouses on, but we have to keep that continuity of title. All right, that's all the time I have. So I'll stick around. Thank you all for your time and attention.